everybody, Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today we have a very special guest. The name is Angela Duncan. She is with Drive Planning. And today we're going to be talking about tax lien investing through a self-directed IRA. Now, I love this topic for two reasons. Number one is a lot of people have their 401k, but obviously you're limited by what investments you can make depending on whichever custodian you have. And what I've become aware recently is that there's all these alternative investments that in some cases can be pretty secure and also pay higher returns on investment as well too. So I'm excited about the show. So welcome to the show, Angela. How are you?
Thank you so much for having me today.
Yeah, I'm really excited. So for our viewers that don't know who Angela Duncan is, who is Angela Duncan? And then how did you get involved in tax lien investing? And then how did you get involved in the self-directed IRA world as well too?
Yeah, so quick backstory. I grew up in poverty. And so I'm actually from San Diego originally. You know, my mom was on welfare, Section 8 housing, never learned about money, and thought I always needed to learn about money. And so went to college, 5-year plan. I became a financial advisor thanks to a movie, was not successful in that realm. So I got my real estate license in 2007, right before the burst, that happened in the housing market. And then I was successful, had a very high performing RE/MAX team, sold that, got into insurance, sold that, and thought, how do I help people really make money in real estate in a more conservative environment that's backed by real estate with money they have just sitting there? And so that's really when I dove into tax lien and tax lien investing and really talking to clients about their IRAs to help them get better returns than what they're finding in the typical stock market.
And also with like maybe a little bit more control as well too than just kind of like I look at the 401k that I have and it just kind of like I just let it sit there. I don't know what's going on. I don't know what the money's invested in. I just know that once in a while it says it goes up. Once in a while it says that it goes down, and I have very little control. So let's say that let's start off here. So what is a self-directed IRA? And then let's say that somebody has a 401k. How can they make their 401k self-directed?
Yeah. So if you have a 401k, the way that you can transfer it over to a self-directed IRA is that you have had to left the company. So if the company is not already offering you a self-directed option, the 401k, you have to actually leave the company. So that's criteria number one. Most people, when they leave companies, they tend to just forget about it and leave it there. But you have to realize in that 401k, one, we have super high fees that are being charged to you as the owner of that. And two, you have very limited options. When I owned my company before and I gave a 401k option, we only went with one company and we were subject to whatever mutual funds they had available. So it was very limited options. So once you've left that company, you're going to roll that over into a self-directed IRA. And what that means is now we have more options for you. A self-directed IRA is looking at non-traditional investments like real estate. You can invest in tax liens. You can actually invest in a business through a self-directed IRA. You can buy gold and silver. You could buy Bitcoin. So it's all the other things outside of the stock market that are now available for you. And you have more control over picking what is it that we're going to invest in this self-directed IRA. So understanding first, you had to have left that job so we can roll it over. But even if you have a traditional IRA or a traditional Roth, we can also take those and roll those over to a self-directed IRA, and you still get that retirement protection, meaning those assets are going to grow without being taxed. So that's an incredible advantage. But these are accounts that people are just sitting on, not paying attention to, not realizing they have so many other options that they could be investing that are going to give them much higher returns. And you have a lot more control than you do over the stock market.
And a lot of times a lot less fees as well too, because a lot of times like the fees, like they compound and obviously the fees are pretty high. So why tax lien investing? And this is something that I did an episode on it maybe like a month or so ago. And then I just read a book on tax lien investing, and I thought about it. I'm like, tax liens and self-directed would actually be like almost like the perfect combination. Why is that?
Yeah, so I like tax liens because when you own a property, your property taxes are due no matter what. And if you don't pay them, what happens is, and it varies by state, but an investor can come in and purchase that tax lien or that tax deed, because if you think about it, the government has a budget. They need money to fund roads, to pay for police, and all of the things that are included in their budget. So if you don't pay your taxes, they still have bills to pay. So they're coming to an investor to buy that tax lien or that tax deed so that they can fund their budget. And in exchange, they're paying you an upfront guaranteed rate. So it depends on states, but Illinois, for example, can pay up to 36% on your investment for a tax lien. I'm in Florida, we pay 18%. And so understanding what the different states offer is pretty critical when you're thinking about tax liens. But also, I recommend that you start in your own backyard, because you could essentially buy a tax lien on a piece of dirt. And that's not a great investment, because if you had to foreclose and sell the dirt, obviously it's not worth as much as a house. So I always say, make sure you're looking at tax liens in your own area first, where you can drive by and make sure there is an asset there that you're investing in. So there's a lot of things, but the also big point about tax liens is they're first in line, meaning if there's a mortgage on that property, the tax lien gets paid first when that house is sold. So the government comes first. The only thing that trumps that is if you own the property and you have back taxes due to the government, that's going to come in line first and then the property taxes. But a mortgage or a roof lien or solar panels, those are all second in line to a tax lien. So it's important to know that you're first in line when you're getting that payment. And one of the things that you want to understand too is about 80% of the tax liens are bought by either the mortgage company that's second in line because they don't want to lose that property, or by institutional funds. And that's kind of where we come in, because we have the advantage of buying in bulk. And so about 80% of the tax liens that go up for sale never hit the individual investor market. They're going to funds, and that gives us an advantage as well.
I love it. I love it. Now, I'm going to backtrack a little bit. So, like, let's say you have a 401k, you left your employer, you can turn that into self-directed. There's also an age where you can turn it into self-directed. Did we cover that or no?
Well, there's not necessarily an age where you can't convert it, but as you get older, we're going to run into required minimum distributions and when you need to take out your funds by. So understanding that when you're investing in a tax lien or real estate and you're self-directed, it's not quite as liquid as like the stock market, right? We've got to sell the asset. It might take some time. With a tax lien, there's some extra steps involved in that as well. So this is really advantageous for maybe somebody a little bit younger that has that 401k to roll over. But once you're hitting like that 62 age, you really want to talk with your financial advisor or your tax consultant to make sure that this still makes sense for you. But for the younger people that are, switching jobs, or if they've got traditional IRAs or Roth IRAs and they want to get a higher return, that's really the ideal market for the self-directed IRAs with the tax liens.
It's funny because I actually was talking to a client. She's like, oh, I have a 401k with my previous company. And I'm like, hey, have you ever thought about making it self-directed? And she's actually going through that process of making it self-directed. So like, let's say that client makes it self-directed now, and she wants to invest in tax liens. Like, what is the typical process? Like, are there certain website that she goes on? How does somebody get educated? How does the bidding process work, et cetera?
Yeah, there's lots of different ways. So the way that our company does it is we use a partner company that specializes in the rollover process, right? So they're the company that actually has to report to the IRS. So the funds will go to them first. And if it's in a 401k, we're liquidating all the stocks. So we're moving it over as cash. And then they provide it to our fund through a transfer. And then we go out and invest on their behalf. If they want to do it on their own, they can also do that. I do say, make sure you're doing your due diligence, title search, making sure there's nothing else that's encumbering on that title that could, you're going to have to pay off, no other liens involved, no other taxes that are involved. So there's a little bit of a process if you're going to do it on your own. But If you're going to do it on your own, there are websites where you can go and buy the actual tax lien or tax deed through auction. And each state varies, but in Florida, we hold them once a year. Each county has their own website, so you can go and bid on it. But you want to make sure that you already have that self-directed IRA in place before you bid, because when you bid, you're going to have to transfer funds fairly quickly. And so having that process already set up is key before you go out and actually start bidding on your own tax liens.
Got it. So in other words, like if somebody wanted to, you guys can handle all that for them.
Correct.
What kind of returns could they expect by using a company like yours versus just doing it themselves?
Yeah, so if they do it themselves, potentially they could get higher returns. I mean, like I mentioned, Illinois pays 36%, Iowa pays 24%. There's a lot of states that pay 18%. In our specific fund that we offer, we are a 3-year hold, meaning you need to understand you're giving us the funds for 3 years because we're going through this process, finding the tax liens, foreclosing on properties, selling the properties. There's some time involved. So ours is a 3-year hold, and you can roll it over after that. You can move it to a different IRA if you wish, but our returns is 22% annual, and that is a written contract with us. So when you're giving us your money to invest on your behalf, we're going to return to you 22% every year for 3 years. And then we can look at it at 3 years and decide, is this still going to be a right fit for you and what your retirement goals are?
Got it. What are the risks associated with the 22%? Like, let's say I invest in the stock market, or let's say that I invest in a like something else. Let's say I invest in a stock market, or even like life insurance. Like, there's a hedge on the negative side. Obviously, if you're earning 36% in Illinois, it seems reasonable that you would be able to pay 22%. Or what are the like anything? There has to be risk associated with that, right?
Yeah, absolutely. I mean, this is real estate. So if we had a massive storm that came through and took out, 3 or 4 states, that could be
No
something
problem.
that could bring, yeah. But we're diversifying in different states, different areas. These are all single family homes, but we're making sure that we've got boots on the ground, looking at the properties. We're doing all the title searches, so it's really meant for a conservative investor who wants to be able to park money. So the risk associated, if a war breaks out and they attack America, or if we have a huge cyber attack and it wipes out all of our systems, that could delay us in figuring out where all the money and profits and everything are. But the biggest risk for us is that having so many states that we're involved in, it would really have to be pretty catastrophic for us to lose that money. But we're not in just one asset. So if you're going off and doing this on your own, you're in one asset and one property, and that's riskier than us spreading it over multiple states.
Which are your favorite states, just out of curiosity? It sounds like obviously Illinois would be one, Florida would be another one,
Yeah.
Iowa might be another one.
Yeah, and we're looking for those states where we can foreclose fairly quickly, where the time frame from the time we buy the deed into the time we could foreclose is relatively quick. A lot of states will do 1 year or less, and so that's kind of what we're looking at. California is a 90-day. Pretty much when we're going to buy that tax lien or that tax deed, we're already going to have access to that property. But we also reach out to the owners of the property, because if they're not paying their taxes, then they're in some type of financial duress, right? So let's figure out a win-win situation. Can we buy that property directly from the client without having to go through that foreclosure process, which can be kind of embarrassing for people, right? If they're in financial trouble, how do we help you get from underneath that asset, pay you cash for the property, close on it, and then we turn around and sell it to our investors? So we want to be able to help the homeowner too, for those that are willing to participate, but that helps us to get higher returns, because now we've got the property, we can sell it for a profit, not only pay ourselves back for the tax lien, which gave us the interest rate from the county or from the city that gave us the original tax lien, but now we're flipping the property. So we're creating income for the fund both ways.
Whenever you guys buy a tax lien, does it come with like a phone number to the person that is in default, or what would be a way of reaching out to them, and what would a conversation like that sound like?
Right. Well, our boots on the ground are looking at the property anyway, so we can do door knocking. But there's so much technology now where we can skip trace, find an email, find a phone number, figure out, maybe they go to a certain church or something. We can find them most ways with technology today. But door knocking is usually the easiest of the forms
Simplest.
because if they're living there, then we can find them. If they're not, then we use some of the other technologies to find them.
And it's basically like, are you guys telling them, hey, look, we actually just bought this tax lien. Like we're planning on going through the foreclosure process. The foreclosure process would be about a year. We would much rather make you an offer on your property as opposed to go through the foreclosure process. Is that something that you'd be open to?
Yeah, absolutely. It's building the relationship with the client, figuring out, what their situation is, why are they behind on their taxes, keeping it in the most simple form. We don't want to foreclose if we don't have to. How can we help you get to your next state in life so that we can help you not have this tax lien burden that you're currently experiencing?
So let's say that I did this process on my own without like your company. How much time would you say I would have to invest? Like, what type of due diligence would I have to do? Like, is it as simple as just going on the website and then start the due diligence process? And what does that due diligence process look like?
Yeah, so I'll take Florida, for example. They release the list of properties ahead of time before the auction. So
Hmm.
start with where you live and where you can drive to. Figure out which properties that make sense for you. It could be a large house, mid-sized, small house. I would stay away from condos because we don't always know what an HOA past due lien might look like because it's not public records. But drive by the property. Then the people you're going to want with your team is a real estate agent because they're going to help you decide if you put this house on the market, what is that price going to look like? Then you want a title company who can do a title search for you, which you're going to pay for upfront. But it helps to determine, what kind of liens are on the property that you can't see. Florida is a public state, so we can see some of the liens, but California, for example, is a private state. Can't always go out and get that lien information, so you need that title company. And then an insurance agent, because when you foreclose on that property and you own it, you want to know what your insurance costs are going to be. Varies from state to state. Florida is very high insurance. Texas is very high insurance. So those are some of your team members that you're going to want to have, and then you're going to need to analyze it. If I pay this much for the tax lien, I have these other liens on there. These are all the fees I'm going to need to do in order to sell the property. And if you've driven by the property, you might have an idea of what the rehab could look like if you're going to go that route. Or maybe you just sell it as is. But you want to have all of those numbers in place so that you understand the foreclosure process and how much money you may be coming out of pocket to determine what your profit's going to be.
You'd probably want a good attorney too, right? A foreclosure attorney as well.
Yeah, I mean, that would be a good addition to your team. Depends on the state. Not every state utilizes an attorney when they're doing foreclosure process. We can do that through a title company sometimes. So it just
Oh, really?
depends.
Actually didn't know that. Good. And then for a title search, any like, I mean, if you're doing these in bulks, I know what title insurance costs. Like it's like, is there like a flatter fee, or is there like a discounted if you do it in bulk, or what does that look like in
Yeah,
terms of cost?
negotiate it with your title company, say up front, if you help me do a title search, it typically doesn't cost them that much money. They have someone on staff that can go do the search for you, right? So maybe you're talking $500 per property, but that's out of pocket, right? You're not
Yeah,
necessarily going to get that back if you don't win the tax deed.
you haven't bought
So if
anything.
you're Right. So if you negotiate them and say, hey, if you give me a little break on the tax lien search up front, then when I close, I'm going to close with your title company. When I sell that property, I'm going to close it with your title company so that they earn extra money from the actual sale versus all the money up front for the tax lien search.
Oh yeah, because that can add up. Now, this is what happened. So in California, the tax deed auction came up in Ventura County. Maybe I think it was on March 4th, and I actually pulled up the list. There was maybe like 30 properties, and then I kept checking up on it. And then every day there would be like properties that would be crossed off. whenever they're crossed off, does that mean that they're selling to like a private fund like yourself off market? Or does that mean that the owner likely paid that amount? Because at the end of the day, there was only one property that was left out of like 30 properties. So I'm like wondering what was happening in the background.
Yeah, both of those are happening. Either the homeowner finally paid their property taxes because they didn't want to lose it in California, because California is a much shorter the foreclosure process. So if they didn't pay their taxes, essentially they're losing their house. And if they have equity in their home, then they want to be able to sell that property and grab that equity instead of losing it to foreclosure. So that's number one. And number two, yes, there are funds that are coming in, institutional size funds that are coming in and buying that and offering the state less than what they're publicly publishing. Like we talked about, Illinois says they pay 36%, but an institution can come in and buy a bulk of those and offer 10%, so that makes sense for Illinois is to sell it to the institution and pay them 10% interest versus online through that auction and paying someone potentially 36%.
Who makes the money in that case? Like if they're paying 30, that's coming from the homeowner, right? That 36% is coming from the homeowner, or that 10% is coming. So who keeps the margin? Like let's say that the state of Illinois is offering 36% and then I'm buying them at 10%. What happens to the 16 or 20%
It
or
stays within the Illinois budget. So they're not having to come out of pocket more to grab that money from you. They're able to just pay you 10% instead of paying someone else 36%. It just keeps it within their budget.
Got it. Well, what's the difference between a tax lien and a tax deed for our viewers?
Yeah, so a tax lien, example again in Florida, is just a lien on the property. I do not own the property at that point. And so it's a lien on the property and it either gets paid back to me or I foreclose and take over the property. A tax deed is when you're actually purchasing the deed to the property when you're going through this process.
Got it. Can you explain the bidding process? And this was like new to me. Like whenever they offer 36%, I'm like, well, do they offer more money or do they offer less interest rate? That was like completely bizarre to me. Can you explain the bidding process? And then also, can you talk about strategy? Like what are some strategies? Like, is the strategy to foreclose on the property? Is a strategy just to collect the 36%? Like, what are some of the different strategies available as well too?
Yeah, so almost every state that I'm aware of does the online bidding process. So you're submitting your bid and you submit it up into the time and date in which they're closing off bids, right? So what happens, and we'll take Florida because that's where I'm at, for example, if I'm looking at one property and I want to buy the tax lien on that one property, well, they're in that state, they're offering me 18%. So I can say, I want to buy this one property at 18% interest. Great. Now, Jose, you come in and you will look at that same property and you say, I want to buy that tax lien, but I'll accept 15%. Then when the bidding closes, the county or the state is going to do what's best for them. So if you're offering to take less interest over what I asked for, they're going to sell you the tax lien, close it, and then you've got 3 days in which to wire over the payment. That's how the online works. From a strategy perspective, it's really going to be up to the investor. Do you want to own the property and have to go through that foreclosure, maybe rehab, maybe flipping process, hiring the realtor, all of that? Or do you want to just be an investor? So if you want to be an investor, my recommendation is to go with a fund. Let them do all of the work behind it because it is kind of time consuming to go through that work. And they're going to give you a percentage of the profits. Obviously, we're going to keep some and we're offering you some, but be the passive investor. Unless you're going to make this more of your full-time business and really dedicate time to it, it's just easier sometimes to hire out a professional, just like you probably have had coaches in your life. It's the same thing. We're hiring it out to a professional who's doing all of the work and really has a system and team in place to maximize those returns. Because if you get stuck with one property and you didn't do your process and your due diligence correctly, you could lose all of your money.
Yeah, and then obviously because you guys are doing it in bulk, it reduces the risk associated with it. What states would you stay away from, or like what states are you like not a fan of, and why?
There is, and I have to remember the website. Maybe I'll give it to you afterwards. But there's a website that shows state by state how much they're paying. Obviously, I would stay away from the states that are paying the least amount, because what's happening in that instance is most likely institutions are just pulling it up anyways, because there's not as many investors in the lower states. But I would stay away from the states that offer the least amount of interest on your investment, because you could probably just go to a regular savings account and get 5%, or a treasury bill and get 5%, or just go buy regular real estate and get a better return. So why spend all that time and energy and effort on a state that's offering to pay you 5%?
How many tax liens do you guys buy a year? Just out of curiosity.
Hundreds and hundreds. I mean, there are billions of, I wouldn't say quite billion, probably about 500 million right now across the US that go up for tax lien auctions. That's unpaid property taxes that people are not paying for various reasons. We hundreds and hundreds. So we've got a pretty extensive team over several states that go out and look for them.
Now, just out of curiosity, like let's say I have my client has their self-directed IRA. She has $100,000 into it. Let's say that she invests in the fund. If I'm doing the math correctly, at the end of year one, it's a 3-year hold. It'll be, instead of 100, it'll turn into 122. And then it'll probably turn into like 145 or 146. And then at the end of year 3, it should turn into like maybe like 170 or 166 or somewhere in that range. Is that really how it works?
Yep. Yeah.
That's
Compounding.
crazy.
Right. Because we're going after the property owner. We want to foreclose. That's our goal. We don't want to sit here and be a passive investor. We want to foreclose on the property, take the equity in the home, flip it so that we're able to just rinse and repeat, right? We're just going to do it over and over. And the compounding effect of that is why our fund is able to give such great returns.
So if you wanted to foreclose on the property, obviously there is hundreds of tax liens available. Like, how do you select which liens are more likely to be able to be foreclosed on?
Right. So we're going to concentrate on an area where we have a team in place, and we get that list sometimes ahead of time, because we're working directly with the county that's doing the online auction. So if we get that list, we're going to go through, pick the properties. Typically, we don't go through condos, because the HOA on that is an unknown. You may have not paid it for 6 months, but you have no idea what their attorney fees are going to be once you get that payoff letter from the HOA. So we're staying away from that. We do like primary homestead properties, because most likely the person lives there and we can get in contact with them much easier than an investor. So there's just certain criteria that we kind of look for. And if it checks the boxes, we're going to offer to buy all of those in bulk, and then be able to go through that foreclosure process so that we can turn a better return for our clients.
Now, are there certain liens that are more likely to be foreclosable than other liens? And is there a way to kind of be like, oh, like liens that are owner occupied, liens that the property is paid off, liens where something that makes it more likely? Because I know that, and this is kind of like, I know that there's strategies behind tax lien investing. And one of the strategies, I think, is just somebody who's like, I don't want to foreclose on anything. I just want to earn my 15, 20, 30% return on my money. And then there's other tax lien investors that are like, hey, my whole goal is to foreclose on it. And that way I'm able to bring in, instead of a 20, I'm able to average 40%, and I'm able to pay out 22%. How do you determine which ones are more likely, or is there not a way to determine that?
Yeah, I mean, investors is probably a little bit more risky, because the information we need to find them is not in the house, right? So it might be a little bit harder to go find them. So that could be a little bit riskier. If they have a loan on it, most likely their property taxes are being paid, right? Because it's in the bank's best interest, since they're not first in line, to keep paying their property taxes. Normally you have an escrow account that's paying for that, right? So when we're looking at tax liens, it's typically a house without a loan on it, or it was a smaller loan that didn't require them to escrow. So when you don't have a loan on the property, that's advantageous for us, because there's equity, right? So that's really the strategy that we were looking for in that instance. But the investors are just a little bit harder to find and locate, especially in privacy states that don't publish a lot of that information. but we do have technology that, your information's out there somewhere. You've applied for a loan somewhere, you've opened a bank account somewhere, you have insurance somewhere. So your information is going to be on the web for us to find.
Got it. Now, if you guys are in first position on tax liens, why do a title search? Is it mainly for IRS liens? Is it to see if somebody's in bankruptcy, or what's the purpose of the if the tax lien takes superiority to almost everything? And then also, what happens if there is a loan that didn't require for the taxes to be paid and you guys foreclose on it? Does that mean that the loan gets wiped out completely?
It can, yes, absolutely. And so that's why usually the bank that's involved is coming through and also making bids on it to see if they can get first position over us. But the tax lien, it has to be paid. So even if we didn't go through the foreclosure process and the bank did, then they need to make sure that we're paid first. And so whatever equity is left over could go to that first lender, could go to the second lender if they have it. But ideally, the taxes have to be paid first.
Now, for tax liens, is it like if I have $100,000, could I leverage that $100,000 to purchase more tax liens? Or is it just I have $100,000, I could only purchase $100,000 worth of tax liens?
If you're doing it on your own, the county wants the exact dollar amount. So if you bought a $100,000 tax lien, you're only able to invest that $100,000. You can't leverage it to be able to buy more.
What about like a fund like you guys? Are you guys able to use leverage?
We don't. No, we don't go out and collect any debt. So the only money that we're going out and buying tax liens or foreclosing on properties is money coming into the fund. But the same thing, if you're putting $100,000 in, we're telling you upfront what we're going to pay you every year. We're not going to pay you more. We're not going to pay you less. It's stated once we go and sign the paperwork with you. Okay. And what's great about our fund too is we can do self-directed IRAs, but we can also do regular investors too. So we have the vehicle and opportunity for both people to be able to invest.
So say that again. I didn't catch that 100%. So you can do the self-directed, but you could also do like a 401k or?
Nope, we can do the self-directed, or if you just have money sitting in your savings account and you want to put that into the fund, then we take that as well.
You can do that as well too. What are the things that could go wrong with this? Like, is there anything that could, like, aside from like a storm or anything like that, have you guys ever bought properties that are burnt down completely, or?
Not when we buy them, no, because we're going to go look at them before we finally close on them. But I mean, that's not to say something couldn't happen to it afterwards. Then we might have to turn the dirt on that. And maybe that's not our best performing asset, but because we're spreading our risk over several states, we're averaging out the returns between our properties. But most times we're going to go look at it before we buy the tax lien so that we can ensure that there is a physical house there.
Got it. Is there anything else that you think people should know about, like, investing in tax liens and doing so in a self-directed IRA account? And then also, like, if somebody wanted to get in touch with your company, like, what would be the best way for them to do so? Maybe if somebody wanted more information, or maybe somebody wanted to invest. This topic to me is like, I'm like fascinated by it. Like 22% return on investment. I'm like, man, that's great, you know?
Yeah. And like you said, you could make a lot more money if you went out and learned the process, put together a team yourself. You could potentially earn 40, 50% depending on your area and what you're looking at. This just gives us a way for you to be more passive and let us do the heavy lifting for you. But I'm super passionate. I've been studying personal finance for 25 plus years. And I've always been very passionate about helping people with their money, growing generational wealth, because I understand what it feels like to live in poverty. I never want anyone else to have that kind of pain because it's a lack of education. That's why they're not getting their financial goals, is because they just don't know what they don't know. So the more that we can tell people about other opportunities outside of the stock market, I think it just helps, diversify their portfolios and has lower risk tolerance when you're taking something and you're putting collateral behind it. So I love teaching about money, and anybody who will listen to me, I talk about money all the time on my podcast. And if we can just reach more people, like through your podcast, and just say there's better ways, there's another way that you can invest that can be more secure. And especially for conservative people, let us do the work for you. And then you asked, how do people get in touch with me? I have an amazing website that gives a lot of information as well. It's called morewithangela.com. And that's it. I want to give more value to you. I want to give more education to you. So morewithangela.com is my website. My brochures are there. You can just download them for free if you just you're curious. But if you want to book a call, then obviously you can reach out to me through my website as well.
I love it. Cool. Well, Angela, I want to say thank you for taking the time to be on the show. I think that this is a great topic. I also think that it's a great opportunity for people to invest in tax liens. I know for myself, I probably wouldn't have the time or the resources or want to dedicate the time in learning that process. However, if there's somebody that's already doing it and doing it at a high level, that's likely a much easier way of doing it. And I was just thinking about this in my head, like literally every 5 years, you're like almost doubling the amount of money that you have every 5 years, which is just great. So I want to say thank you for that. For our viewers out there, we had Angela Duncan. We talked about tax lien investing through self-directed IRAs. If you've enjoyed this topic, make sure to hit that subscribe button. If you feel that this episode would be helpful to somebody, make sure to hit that share button. Thank you again, Angela, and to our viewers, until next time.
Thank you so much for tuning into Empower Her Money podcast. Hope you enjoyed this episode. Don't forget to subscribe, share this podcast, and leave a review wherever you are tuning in.